The career of the master speculator stands as a testament to intellectual fortitude, a man who could outthink, outweight, and ultimately outtrade the entire financial world. But the final, most devastating chapters of his story reveal a profound truth. The greatest enemy the speculator ever faces is not a cornered bull or a collapsing market, but a personal weakness, a single compromising thread in the tapestry of his human nature. Jesse Livermore achieved an unparalleled mastery over the forces of fear and greed on the ticker tape, yet he was ultimately destroyed by an enemy he encountered not in a trading booth but across a friendly luncheon table. His final great downfall was the catastrophic result of allowing a personal obligation to fatally compromise his objective market judgment. At the time, the master was in a desperate situation. He had already lost one great fortune due to errors in timing and emotional overcommitment, and now found himself broke, but possessing an asset far more valuable than cash: the clear, painful knowledge of his own past mistakes. All he needed was a stake and a square deal, a reputable firm where he could trade on the strength of his own analysis. It was precisely in this vulnerable moment that the trap was set. A prominent member of the Wall Street establishment, Dan Williamson, approached him with a proposition. Williamson, a thorough gentleman of education and immense wealth, offered the struggling speculator a chance to return to the game. The offer was audacious: a personal check for $25,000 given to Livermore to deposit in his own bank account for margin. This was not a credit line. It was cash, lent with a friendly smile and the promise of more if that went. But generosity in Wall Street is rarely without motive. Williamson's true purpose was not philanthropic. His firm was deeply involved in the massive holdings of his sick brother-in-law, Alvin Marquand, who was secretly the president of the great Chesapeake and Atlantic Railroad system. Marquand was dying, and Williamson was tasked with the immense, delicate operation of liquidating his speculative holdings without crashing the market. He needed a disguise, a diversion, a smokescreen. He needed a notorious, successful speculator whose high volume of trading, particularly short selling, would mask the massive distribution campaign being conducted by the firm. Livermore's reputation as the greatest speculator, and plunger, was the perfect camouflage. The master trader was to be used as an unwitting pawn. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. For those who are committed to this journey of knowledge, who return to these lessons to sharpen their minds after the inevitable setbacks of the market, your support is the fuel that keeps this conversation deep and useful. Livermore accepted the check, banked the money, and began trading. He was quickly regaining his confidence, making massive profits and proving that his judgment was indeed correct. He saw the market with crystal clarity. His analysis told him a bear trend was inevitable, and he began shorting railroad stocks, including Chesapeake and Atlantic. He knew, with the unshakable certainty of a master, that the great tide was turning. He had correctly diagnosed the end of the market move and was positioning himself for a massive killing. But Williamson, who was fighting desperately to support the stock long enough to liquidate his brother-in-law's estate, was watching. He knew that Livermore, the man whose analysis he himself respected, would destroy his entire operation. This is where the psychological battle reached its crisis. Williamson called the speculator into his office. He did not appeal to his intelligence. He appealed to his gratitude. He insisted that he knew things Livermore could not, that his short sale of Chesapeake and Atlantic was a bad play, and that he had already covered the speculator's position and gone long in its place. Livermore, having been shown immense generosity and kindness, could not do less than yield. He knew Williamson was Williamson's friend and partner. To refuse was to insult his benefactor. The simple professional truth was that Livermore was right to be short, but he compromised his judgment out of a sense of personal obligation. He wrote later that he was, "To subordinate my judgment to his desires was the undoing of me." The core of his success was his absolute independence and trust in the tape alone. By allowing personal debt and gratitude to overrule that objective truth, he committed the single most costly error of his career. Livermore possessed the mental acuity to see the true direction of the market, the Wyckoffian distribution phase being conducted on behalf of Mark I's estate. But the Wyckoff concepts and the logical certainty they provided were rendered useless. Williamson, in a stroke of genius, had used Livermore's great virtue, his sense of honor and gratitude, as a psychological weapon to force him to abandon his correct position and step directly into a colossal financial trap. The speculator was now out of sync with the market's trend, and the long, agonizing spiral into total ruin had begun. The speculator had just committed the single most destructive error of his career. He had allowed a man, a friend, a benefactor, a creditor, to overrule the clear, objective, and solitary message of the tape. He had compromised his judgment out of a sense of deep personal obligation. But the price of this compromise was far higher than he could have ever imagined. The market, which had already given him his victory signal, now proceeded to march forward in the direction he had correctly foreseen, leaving him stranded on the shore, watching the profitable tide recede without him. The situation was dire. Livermore was now tethered by a bond of debt and gratitude to a firm whose primary objective was not speculation, but the vast multi-million-dollar liquidation of a dying man's estate. The objective of Dan Williamson was no longer to help the speculator make money. It was to use the speculator's reputation and trading volume to mask his own firm's massive secret distribution campaign. The moment Livermore covered his short and went long on Chesapeake and Atlantic to please his benefactor, he traded his clarity for his comfort, his independence for his obligation. This marked the beginning of the downward spiral. Williamson, a master of genteel manipulation, did not demand immediate repayment of the $25,000 loan. Instead, he used the debt as a silent, invisible leash. He continuously fed Livermore into trades that served the firm's hidden liquidation needs, not the objective signals of the market. Livermore would build a promising position on another stock, only to have Williamson call him into the office to present some new, compelling inside information or reassurance that subtly steered him back toward the high-volume liquidating positions, the very stocks that Williamson needed liquidity for. The great speculator, the man who had perfected the art of sitting tight and trusting only the tape, now found himself constantly maneuvering, trading on tips, and chasing minor fluctuations to generate the commissions and activity that Williamson required for his smokescreen. He was no longer trading with the detached, ruthless logic of a professional. He was trading with the anxious, frantic energy of a man desperate to please his creditor. His initial profits quickly vanished, devoured by commissions and small, unnecessary losses. The $25,000 loan, once a generous opportunity, became a crushing burden. He was trading, but he was no longer winning. He was not only back to zero, he was sinking deep into debt. The true, deep psychological cost of this situation was the loss of independence. The speculator's most vital asset is not his cash, but his mental clarity, his unbiased objectivity, and his absolute freedom to act upon the unvarnished truth of the tape. By subordinating his judgment to Williamson's desires, Livermore had sacrificed this very asset. He became a puppet, whose decisions were controlled not by the movements of the stock price, but by the financial needs and requests of his creditor. "When I was in debt to a broker," Livermore wrote, speaking of this period, "I could not feel free to follow my own judgment. The pressure of the debt became a mental incubus, a crushing psychological weight that strangled his ability to think objectively. He was forced to focus on the trivial goal of covering his margin or pacifying his creditor, rather than the massive, profitable goal of capturing the primary trend. The voice of his benefactor became louder and more demanding in his mind than the silent, truthful voice of the ticker tape. The insidious trap of this relationship was its alternating cycle of abuse and generosity. Williamson would allow Livermore to plunge deeper into debt by following his bad advice, only to then perform an act of great, seemingly selfless kindness. Livermore recounted a parallel tale, that of the trader Roberts, which perfectly illustrates the dynamic. Williamson would call him in and declare, "You owe us $1.25 million. We know you can't pay us. But we know what a great trader you are. We are simply charging off your debt and opening a new account for you. Go out there and start fresh." This act of forgiveness was not charity. It was the master predator giving his prey just enough rope to hang himself again. By forgiving the debt, Williamson was not only reinforcing Livermore's profound sense of gratitude, but he was ensuring the speculator remained completely bound and obligated, ready to serve as the firm's smokescreen. In the next liquidation campaign, Livermore was a highly valuable tool, and Williamson was ensuring that tool was always sharp and psychologically indebted. Every time the debt was forgiven, the speculator's mental independence, the core of his power, was sacrificed anew. The final painful truth dawned upon him not through an analysis of a stock price, but through an analysis of human nature. He finally looked past his gratitude and saw Williamson for what he was, a manipulative operator whose kindness was merely a means to an end. Livermore realized that he had lost all his money not because the market had beaten him, but because he had allowed a man to stand between him and the tape. He was trading Williamson's needs, not the market's reality. At that moment, facing the full, terrifying weight of a devastating multi-million-dollar loss, the speculator made the only correct professional decision: the revelation and the exit. He decided that the cost of being polite, the cost of showing gratitude, was too high. He would sacrifice the last of his remaining money to save his mind. He walked away from the office, severing the relationship entirely, cutting the poisonous thread of obligation. He had lost his last fortune, but in doing so, he had done the most important thing of all. He restored his self-respect, his objectivity, and his complete, uncompromised fidelity to the tape. He regained the speculator's most crucial asset, the freedom to act based purely on the market's evidence. He was broke, massively in debt, but for the first time in months he was free to think clearly again. He had lost the money, but he had rescued his mind. The long, agonizing spiral of compromise had reached its inevitable conclusion. Jesse Livermore, the greatest speculator of his age, was once again ruined. He had walked away from the firm of Williamson and Company, but he had not walked away from his liabilities. He was staring at a debt that exceeded $1 million, a staggering, crushing sum that represented a decade of hard-won capital. The market, in a final act of impersonal cruelty, offered him no immediate opportunity for a swift restorative victory. The quiet, relentless pressure of his creditors had replaced the loud, clear pressure of the ticker tape. The weight of this colossal debt was not merely a financial problem. It became a deep, corrosive psychological condition. Livermore referred to it as a mental incubus, a nightmare that sits upon the mind, paralyzing the very ability to think clearly. The true tragedy of the moment was that the man who had perfected the art of cold, objective reasoning was now sick, nervous, and unable to reason calmly. The debt consumed his focus. Every decision, every analysis was now filtered through the desperate need to get even or satisfy the relentless demands of his creditors. He was no longer trying to read the tape. He was trying to read his bank balance and the faces of the men he owed money to. The pressure forced him into the greatest sin of all: hurry. He could not wait for the clear, perfect signals, the five-star setups that had been the foundation of his greatest successes. The debt demanded action, and action born of desperation is always costly. His mind, once his most potent weapon, was now chained. He was a general whose vision was obscured by the smoke of his own besieged camp. The great psychological lesson of this period is that debt destroys objectivity. It forces the speculator into the role of a desperate gambler, substituting logic for hope and system for impulse. Livermore was trapped in a vicious cycle. The debt made him nervous. The nervousness made him trade poorly, and the poor trading increased his debt. He was rendered incapable of making the great comeback trade that he knew intellectually he was capable of. Faced with this paralyzing psychological condition, Livermore made the most radical yet strategically sound decision of his entire career. He declared bankruptcy. For the public, this was seen as a final, humiliating defeat, an evasion of responsibility. But for Livermore, it was an act of profound strategic defense. He was not declaring bankruptcy to escape payment. He was doing it to free his mind. He realized that as long as his energy and focus were dedicated to juggling creditors, negotiating deadlines, and listening to the accusations of those he owed money to, he would remain a crippled speculator. His capital, his wealth, was irrelevant. The one true asset that would enable him to make another fortune was his mental independence. Bankruptcy was the surgical procedure necessary to remove the incubus. It gave him legal protection from the relentless, soul-crushing pressure. It was a formal, public acknowledgement of his financial defeat, a necessary sacrifice that allowed him to retrieve his intellectual sovereignty. He knew that once his mind was free, the money would follow. This was his last, most crucial strategic defense. He burned the boats not to escape, but to ensure that his mind, the true source of his power, was once again fully devoted to the tape, unburdened by external pressure. The decision required immense courage, but it was the only professional choice that offered a path to long-term survival, and eventually, a glorious return to the market. The final ruin of Jesse Livermore was not caused by a flawed system, a bad chart analysis, or an incorrect trade. His system was sound. His analysis was right. The single mistake that cost him everything was an error in self-management and debt management. The ultimate lesson is this: the speculator must be financially, psychologically, and morally independent. Any factor, debt, gratitude, personal influence, or outside tip, that threatens the absolute objectivity of your judgment will eventually cost you everything. Livermore's downfall was the price paid for mixing business with personal obligation, for compromising the sanctity of the tape's message with the noise of a benefactor's request. His life proves that discipline must extend beyond the trading screen. It must guard the mind against all external contamination. The speculator must be a solitary figure, loyal only to his strategy and the market's own truth. For those who wish to truly master the greatest challenge in speculation, the challenge of controlling yourself, there is one book that stands above all others: Edwin Lefebvre's Reminiscences of a Stock Operator. This book is not a memoir. It is a profound philosophical study on the cost of compromise. Lefebvre does not just recount the historical events. He captures the internal monologue of the speculator during his darkest hours. He documents the excruciating mental toll of debt and the absolute, non-negotiable price of independence. This book serves as the most important case study on self-sovereignty in all of finance. It is your opportunity to live through Livermore's ruin and his subsequent disciplined recovery, understanding the mental battle that preceded his greatest triumphs. A link to this essential edition, which includes a unique chapter-by-chapter analysis by Max Davidson specifically designed to translate this timeless wisdom for the modern reader, is provided in the description below.